Law and Finance Seminar. We are very fortunate to have today as speaker Florian Ederer. Florian is an associate professor of economics at the Yale School of Management, and he has published widely in leading journals on issues at the intersection of, let's see if I remember all of the topics that he's covering in his papers. So on issues from organizational theory, the economics of competition and innovation, and behavioral economics. And he has published a number of papers that have become quite influential and prize-winning. And I would think that the paper that he's going to present today on common ownership, competition, and top management incentives will probably become a part of this line of influential papers, because it contains a number of important policy lessons, and it calls into question much of what has so far been written about common ownership in the corporate governance literature. So I'm very much looking forward to his presentation and the discussion. Florian is going to talk for about 15 to 20 minutes, and then, as usual, his presentation will be followed by two discussants. David Kershaw, he's professor of law at the London School of Economics, and then Vicente Cuñat, who is associate professor of finance also at the London School of Economics. So thank you very much, Florian, for being here and agreeing to present this very interesting paper. The floor is yours.
Okay. I should also say before we begin that this session is recorded. So if you don't want to hear you being recorded on what I have to say now, now's the time to log off. This is a joint work with Miguel Anton Maria Chiné and Martin Schmalz, who are at ES and University of Oxford respectively, and all the great stuff in this paper is of course their work, and all the remaining mistakes are my own. As Carsten said, this is a combination of three different topics: common ownership, competition, and top management incentives, and very much a reflection of what I usually do, which is stuff at the intersection of different disciplines within economics and finance. Okay, so I will assume that most of you will be familiar with this term of common ownership. Very briefly speaking, what is common ownership? Common ownership, it just means that the largest investors within the same industry, so across a range of industry competitors, are the largest shareholders within several of these competitors. So if you look at here, the largest 6 airlines in the United States, okay, you can see that BlackRock, Fidelity, Vanguard, and sometimes here also Berkshire Hathaway show up as the largest shareholders in every single one of these companies. Now, this is a relatively recent phenomenon, if you look at long secular terms, because that type of arrangement, which not only happens in the airline industry, but happens across all publicly listed companies pretty much in the US, but also in Europe, that has really been rising since the 1980s. You can see these sort of like the weight you put on your competitors in terms of the shareholdings of your own shareholders has increased by as much as threefold since 1980, going to 2017, as documented in this beautiful paper by Matt Backus, Chris Kilconlon, and Mike Sinkinson. So what does this all mean? Well, it means that when you have several large investors that own shares in many firms in the same industry, probably they have reduced incentives to compete. How does that play out? Well, maybe the firms produce fewer units, they raise prices, they reduce investment, all kinds of anti-competitive measures that might be taken, because now suddenly the firms take into account that if they compete very intensely, that has negative repercussions on other industry competitors that are also owned by the same set of shareholders that they themselves have as large shareholders for their own company. Now, I said that this is a recent phenomenon. Well, it's a recent empirical phenomenon, but it has actually long intellectual history on the theory side, starting with the work of the late Julio Rotenberg. It now is also one of the hottest topics in antitrust, which I guess is why I'm here. People claim, for example, that common ownership has stimulated a major rethinking of antitrust enforcement. But the reason why we wrote this paper is that in all of these papers that have been written on common ownership, both on the theory and the empirical side, there's a mechanism missing. Is that many of these papers just directly assume that the investors run those firms. But of course, we know that the managers usually run these firms. Differently speaking, BlackRock's Larry Fink is the CEO. He doesn't phone up the managers and tells them, in this serial market, I'd like you to charge higher prices, or on this airline route, I'd like you to charge higher prices. That probably doesn't happen. And of course, we know that collusion is illegal, so we can't have investors or firms getting together and raising prices. So what is it that we do? That's exactly when we come in. we say, well, look, we're going to develop a mechanism. And why would we need that mechanism? As well, all the regulators are saying we can only have policy on common ownership until we know the mechanism. So both the FTC as well as the SEC have explicitly mentioned that they want to see a mechanism of harm first, through which common ownership affects product market outcomes before they can proceed with policy action on this. So the reason why we write this paper is like, there is no mechanism so far. Everybody wants to see a mechanism. That's why we do this paper here. Okay, so what does this paper do? It has 3 ingredients from 3 different fields: organizational economics, industrial organization, and corporate finance. Here's the most important thing that you're going to hear in the next 15 to 20 minutes. This is the mechanism according to our paper. More common ownership leads to lower managerial incentives at the firm level. So that means the managers are less incentivized, they put in less effort, the firm is less productively run. Because the firm is less productively run, that leads to endogenously higher prices, lower quantities, so less competition. And that also even means that across different markets, the firm is going to compete less or more intensely or aggressively in their quantity and price choices. So it's a plausible mechanism that reconciles the seemingly conflicting evidence in that we do not have investors directly choosing these things. We do not even have managers directly choosing these things, but we have full-on delegation, just like you'd expect from any normal organizational economics model. Then we do something else, which is we then test this empirical mechanism. We look at, is it really the case that when common ownership goes up, managerial incentives go down? And we confirm this in 2 ways. First, we show that in the cross-section, in the panel, where we document a negative empirical relationship between common ownership and managerial incentives. And then we have a simple difference in differences in design, where we use index additions from competitors. So we were not changing the ownership structure of the company that is being treated, but rather we're just changing or allowing a change in the ownership of other companies. And that in turn leads to a change in the common ownership words of that treated company. And we confirm that that indeed leads to a reduction in the managerial incentives given to the managers on top of these firms that now have more common ownership. Okay, so let me tell you again what has been done in the literature so far. The literature essentially assumes that there are these investors out there, they own several firms in the same industry, and then they directly set prices to maximize their portfolio profits. So you can see these portfolio profits is this phi I plus pi I. Pi I is just the firm profits that you usually maximize. But because they have shares in several companies, they also maximize this pi j, these profits of other firms. Okay. Now, of course, that's a ridiculous mechanism because it assumes that the investors are directly choosing market level prices. Instead, what we're going to do, we're going to have something like this, where the investors are setting incentives for the management, or even loosely more speaking, they decide to intervene in terms of governance with top management. Top management in turn invest in cost reduction or invest in productivity improvement to maximize whatever incentive contract they're given. And that in turn then leads into pricing specialists setting prices to maximize the profits of the firm. So it's a hybrid model where really the investors have very, very limited way of influencing product prices, but we'll show nonetheless that this mechanism is consistent with all of the empirical evidence that has been put out so far. Okay, so the investors are not directly controlling the ready-to-eat breakfast cereal prices, okay, that we would usually study in an industrial organization, but they have to do this indirectly through setting managerial incentives, which in turn influence what pricing specialists do. Okay, here's the key intuition of the model. You have stronger managerial incentives. When you give stronger managerial incentives, organizational economics 101 tells you, well, then the managers are going to exert more effort. Okay, and we'll call this productivity improving effort EI. That now in turn has 3 effects. You're going to have a margin effect, which is that reduces the costs and in turn increases the margin. So that's great news for the firm. There's a second effect, which is the price effect, which is once the cost goes down. So once I've improved productivity of the firm, the cost goes down. That now means that the firm would like to sell more. So there's an increase in the market share. again, that's great news. And that yields actually a multiplicative effect because you're multiplying the margin effect and the price effect. There's a third effect, which is the competition effect, which is that if I, as a firm, are setting lower prices, that's great news for me, but that's terrible news for my industry competitors because I'm drawing away now market share and profits from them. As an undiversified owner, I only care about 1 and 2. I don't care at all what happens with effect 3 because I don't own shares in these other competitors. But as a common owner, I also care about that competition effect. Okay, and that's this red thing in the first order condition that I've written there. So at the margin, as a common owner, you would like to set lower incentives because you want to discourage your manager exerting too much effort, which in turn leads the firm being very productive, which in turn leads to the pricing specialist setting very, very low prices. Okay? So at the margin, these common owners have lower incentives to set very strong incentives for their managers. So what does that all mean? Well, I'm going to skip all the uninteresting theory and get you straight to the result, okay? Which is that the managers are going to face weaker incentives to improve firm efficiency as common ownership increases. The way that this works here in our model is through strategic product market competition, which is when you give strong incentives to the managers, that feeds back into lower costs, which in turn leads to lower prices set by the pricing specialists, which in turn leads to lower profits of these other firms. And because you want to discourage that, as a common owner, you set lower incentives. But you could think of any other mechanism. It doesn't have to be strategic product market competition, where anytime you get incentives to the manager, that leads to negative repercussions for other firms' profits, you would get the same type of intuition. Okay. Now, important interpretation for corporate governance. Okay. It's not necessarily that these common owners are directly choosing lower incentives. Okay. In fact, what we have as an extension of the model is we also explain why these common owners are found to be so passive in the first place. So one way of conceptualizing this is think about owners having to pay a governance cost G greater than 0 if they want to design incentive compensation for top managers. Well, these common owners, they're perfectly happy to let the managers enjoy the quiet life. They are perfectly happy with letting them just have low incentives. So therefore, they don't have an incentive to engage in governance in the first place. Only undiversified maverick owners have that incentive. So it's not necessarily that common owners are deliberately choosing low incentives. They just choose to be passive. Okay, so we provide an encompassing explanation for why you have passivity in the first place as a common owner. Snarkily put is what we need, what happens in our paper is that the only thing necessary for the triumph of anti-competitive common ownership is for corporate governance to do nothing. So it's not that you have to be actively involved to lower incentives or that you have to engineer in some way anti-competitive outcomes. It's perfectly enough for you as a common owner to just be passive. Okay, there's a bunch of other things now in the paper that also get you a bunch of additional empirical results. I'm going to skip over them. The most important part, I'll just say, is that we can also get intra-industry price variation within even the same firm. So a commonly owned firm can price differently across different markets in a way that looks actually like collusion, but turns out not to be collusion, but just all caused by endogenously determined costs. Okay, so I'm going to if you're interested in that, I can speak more to this, but I'm going to skip this for the interest of time here. Okay. So the important thing again in our model is that these price effects are not driven by collusion, by endogenously determined costs. And even more importantly, you will find that these markups are essentially unaffected because what the driving forces in our model is that these common owners are really just trading off. Do I want to have a very productively, efficiently run firm? But if I want to have that, then I'm also going to have very aggressive competition. So instead, I'm going to trade off a little bit productive inefficiency with some form of softer competition. Okay, there's lots and lots of existing empirical evidence, all of which can be explained by our theoretical model. Okay, so I'll just put these up there. I'd say the most interesting ones are the recent findings of Bab and Katan and Heath et al. On governance, where we also find evidence consistent with common owners being less actively engaged in governance. Now, importantly, again, this mechanism is plausible. The theoretical results don't rely on any sophisticated market level evidence. They don't rely on the top managers knowing underlying ownership structures. They don't rely on top managers making market specific strategic choices. They don't even rely on these product market specialists, these pricing specialists knowing owners' interests or top managers' preferred strategies. So I think there's a fundamental misconception in the corporate governance literature on this that tends to think that all of these things are necessary for common ownership to have anti-competitive outcomes, when in fact we show that this is not necessary at all. Okay, let me say a few things about the empirics that we then do. There's a tight link here in terms of theory and empirics, which probably is more interesting for economists, in that we have a multiplicative model. Theory guides us then in saying, if you have a multiplicative model, there's a particular measure of wealth performance sensitivity, which you can think of just as the incentive slope. We then use that specific measure of wealth performance sensitivity from Edmonds et al., put that in model, run standard executive compensation regression, but just have on the right-hand side this additional thing, this kappa, which is essentially the profit weight that you as a firm have on other firms because of the shareholdings of your largest owners. Okay, so when we do that, we run essentially in a regression like this one, wealth performance sensitivity on the left-hand side, a bunch of usual regressors on the right-hand side, plus this common ownership measure COIT, the usual set of fixed effects, okay, to make sure that we're not picking up some spurious correlations. So binary of robustness check, all of which are super uninteresting and are buried in the 95-page paper with its 50-page appendix. Okay, here's what you came for. It's like, first, we're going to show that there's a negative relationship between common ownership and managerial wealth performance sensitivity. Okay, so when common ownership goes up, as measured by this kappa, by this weight that you attach on other firms, on other in the same industry, given by your shareholdings, then that means that your managerial wealth performance sensitivity goes down. Your incentive slope for the manager goes down. How much does it go down? Okay, these are rank order transformations of kappa. So you have to basically halve them if you want to do an interquartile range. So if you move from the 25th percentile to the 75th percentile in terms of common ownership on a firm level, that reduces wealth performance sensitivity by about 6%. Here's a battery of robustness checks with other measures of wealth performance of common ownership, not just kappa, but cosine similarities, top 5 overlap, and so on. You get pretty much very much consistent results. Okay, always negative effects on the wealth performance sensitivity. You can do this with different measures of wealth performance sensitivity. So rather than the Edmonds, Gabex, Londier, you can use Jensen Murphy or Hall-Lippmann. You get very similar results again. You can do this with not just top executives. You can do this with all top executives, not just CEOs. You get, again, negative effects. These tend to be a bit smaller, and I can give an interpretation for that, but let me skip over that for the moment. Okay, but consistently find in these panel regression results that when you shift up common ownership, you get a reduction in CEO wealth performance sensitivity. How big is this? Okay, well, 6.6% is pretty large. That's actually as big as the effect of firm volatility. How big is this in terms of dollar terms? Well, it's somewhere in the region of $10 million. Okay, so for somebody who is like S&P 500 CEO, you get about $140 million over the course of many years. If you have a 50% increase in shareholder value, okay, that would be about $10 million lower, this 140, than in a situation where you had already relatively high or low common ownership. Okay, now the last thing I want to do before I hand over to my excellent discussants, okay, is that I will tell you something about these difference in difference estimation that we run. One major concern in everything that I've shown you so far, okay, both in the theory and in empirics, is that we assume that ownership is essentially exogenous. Okay, it's that we already arrive at this common ownership stuff. There's no strategic choices of common owners deciding they want to be common owners. Okay, and if you think about this Berkshire Hathaway example that I gave you at the very, very beginning, maybe there is a conscious decision here to invest in several firms in the same industry. Okay, so how do we address this question then? One thing we do is we just do straight up intellectual arbitrage, and we steal the identification strategy of Kohler and Scott Morton, a recent NBR working paper. What's the idea here is imagine an industry with 3 firms, A, B, and C. Okay. 2 of these firms are already in the S&P 500. Now C gets added to the index. Okay, so the ownership of A and B doesn't change at all. But because C gets added, lots of institutional investors now buy C because it got added to the index. These institutional investors already own A and B. Okay? So therefore, the common ownership weights in A and B have changed, even though the ownership itself at A and B has not changed. Okay? So we're going to use here now this ownership of these treated companies that actually remains completely the same, except for the common ownership weight change due to the ownership change at that other firm, namely firm C, and check whether that induces then a reduction in wealth performance sensitivity. Okay? And well, of course it does, because otherwise I wouldn't be telling you about this. Okay? I can show you first the difference in difference results in somewhat boring regression table, but let me show you to them in a much better graphical format, okay, which is this one here. So this is for a crisp industry definition. This is years -5, -4, -3, year -2, -1. Then the year of the index addition of firm C. And here we're looking at the wealth performance sensitivity of firm A and firm B. Okay? And you can see that that starts trending down after C got added to the index. Okay? So after I get an addition of an index competitor, my own wealth performance sensitivity goes down. And notice also that doesn't happen immediately. Okay? It doesn't happen in year 0 when the competitor gets added to an index, but it happens gradually. But notably, it doesn't happen at any time before. So the pre-trend is pretty much completely flat around 0. And that's true not just for crisp measures of industry, but also for CompuStat measures of industry. Again, you see the same pattern, no effect before the index inclusion of a competitor, but then in the next years following the index addition, you get a trend downward in the managerial wealth performance sensitivity. And the same is also true for Holberg Phillips industry definitions. No effect before the addition of the competitor, and then a negative gradual effect after the addition of the competitor. Okay. So what does that mean in terms of difference in difference results? Where we get relatively similar magnitudes, the index addition of that competitor leads to reduction of CEO wealth performance sensitivity at these index incumbents somewhere between 10 to 16%. Yeah. All right, so I've come to the end of what I want to say. Let me just remind you what the paper says. It says managerial compensation is a simple mechanism through which common ownership can affect product market outcomes, including this intra-industry cross-market variation in prices that have sparked this entire literature. But importantly, and here's where I really want to emphasize things, is like what this paper does not say is the following. It doesn't say that managerial incentives are the only or even the primary mechanism. It is nonetheless the first one, and the first one for which there's both the good theoretical model as well as empirical evidence. But I should also warn you that you shouldn't come away from this, that even if you accept that we now document a mechanism of harm through which common ownership affects product market outcomes, you shouldn't think that common ownership is necessarily welfare reducing, or let alone that index funds are evil. However, we do believe that these results have very important implications for the evaluation of existing empirical works on common ownership, and more broadly at the intersection of industrial organization and corporate finance. And hopefully they can start informing also antitrust policy and financial regulation, because there's little bit just two extreme positions here. One that says, oh, this is a terrible, terrible situation and we must do something about this immediately. And another situation that just says, well, we don't have enough evidence yet. Okay, let's just wait and see. Okay, I'm going to stop here. Thank you for this time, and I very much look forward to what my discussants have to say.
Thanks very much, Florian, for this very clear presentation and that very, very compelling empirical evidence that you presented. So I will hand over to David now first for some comments from the legal perspective.
Can you see my screen, Carsten? Is that good?
Yes, all good.
Okay, well, first of all, thank you guys for inviting me to comment on Florian's paper, and thank you also for setting up this fantastic seminar series that is so great. So thank you to the three of you. This is a fantastic paper, right? It's a really interesting, innovative paper. Exactly the sort of paper that we love to have in our courses, right? We could spend the whole day talking about this paper. So it's really fabulous. But I guess the problem from my side is that being as a mathematically challenged lawyer, there are some limits to the extent to which I can either understand what's going on here in this model and critique it. So I'm going to keep my comments to the core sort of theory, the core idea here of the paper. And my screen is not. Oh yeah, there you go. Okay. So as Florian outlines, right, this is a paper that's in search of a transmission mechanism. So we have a bunch of empirical work identifying anti-competitive correlations with common owners and a theory that explains why common owners might have anti-competitive pricing and behavioral preferences. But thus far, no one has come up with a plausible account of how those preferences are transmitted into the boardroom. So we might describe, I guess, the state of play with the common ownership debate is that it's a causal connection in search of a transmission mechanism. And Florian and his co-authors offer such a transmission mechanism, which is a non-active transmission mechanism. Now, I'll skip this slide because obviously Florian has done a fantastic job in explaining the core thesis of the paper, and its implications are fascinating. Fascinating, of course, for competition and for markets. If these effects are real, it's actually very difficult to actually work out how we might try effectively and control them. But it's also interesting from the corporate governance perspective as well. Super interesting, because what it's saying is that fund managers are not inactive just because they have poor financial and time incentives to be inactive. That might be true, but even if that's true, when they are common owners, it is in their financial interest and the interests of their ultimate owners to be inactive and undemanding. So from this perspective, common ownership theory offers as an alignment between managerial incentives to enjoy the quiet life and fund managers' interest to be passive, which is fascinating. But I guess maybe the biggest issue I have with the theory of the paper is around this assumption about a common owner's behavioral preferences. And I wonder whether the assumptions are just too static. Maybe I could take a little bit of time just to explain what I mean by that. So here we have a common owner who owns shares in 5 different companies. And according to Florian and his co-authors' theory, what the common owner wants to encourage is, if you like, indirect, implicit cooperation, where you don't invest in efficiency savings, you don't invest in productive enhancements. So you're incapable really of competing on price. You're incapable of taking market share, and you end up in this wonderful common ownership ecology in which the common ownership value position is increased. Now, as in any, we might call that the lazy alignment strategy. Okay, so now, but as in any market, there's a bunch of other companies that are hanging around this market looking to enter this market. They're looking to take market share. They're looking to compete on pricing. Now, their ability to do so is going to be dependent upon a bunch of market-specific factors. Are there barriers to entry into that market? Are there barriers to taking market share from that market? Are there other barriers? Is this a market that is purely a domestic market and not exposed to international competition? Is this a market that's subject to structural takeover barriers? And I think if we think about that sort of market, actually, well, it's going to be very difficult for those companies to enter that market. Some may, but few will. And this strategy, this lazy alignment strategy, makes a lot of sense. Now, one such market, I think, might interestingly be the airline market. And if that's your market, then as a common owner, then it seems to make sense that the optimal comp structure is a low-powered one, driving this lazy alignment theory. But what about those markets that are not as protected? What about those markets where there are no barriers to entry, where there are very few barriers to taking market share? What about markets that are exposed to international competition? What about markets that are not subject to structural takeover barriers? Now, in those markets, there is a significant risk that this value enhancing strategy disappears and the mavericks actually come in, and instead of looking nice like this, it ends up looking like this, right? In which your companies have either been destroyed or they're worth a lot less, and your overall value as a common owner is much less. And the last thing that you want your companies to do in such a market is to indirectly cooperate. You want them to fight for their survival. And in those markets, the optimal compensation structure for a common owner is not a low-powered incentive structure, it's a high-powered one. And if you don't have a high-powered one, you might end up holding, you might say, a bunch of BlackBerries, right? So think of mobile phones. Think of high street retail in the noughties. Think of healthcare today. Think of automotive today, right? In those markets, the last thing that a common owner wants is low-powered incentives and lazy managers. Now, that point, I think, is particularly salient, Florian, for your claim. Because if you are a manager responding to common owner incentives not to compete and you raise prices, then if it turns out that that's not working in that market because the mavericks are coming in, you can change your mind quickly. Now, if you're in a market where your response has been not to invest in efficiency savings or productive enhancements, you can't change quickly. So if you adopt that strategy, there is a significant risk in those markets of exactly the wipeout that we see on this board. Now, that means from the common owner's portfolio perspective, there are a whole range of different companies in different markets in its portfolio. For some, the lazy alignment strategy makes sense and you want low-powered incentives. But for many others, the lazy alignment strategy risks wipeout and you want high-powered incentives. Now, if that's right, then it can't be clear that a common owner's lower-powered incentive correlation represents a conscious or apathetic preference for the easing of competitive pressures, because in many instances that choice will destroy value. So that can't be right. Now, the next question, it seems to me, that follows from that is then, is it plausible that the low-powered comp represents a reward choice, having done the computation here between the different possible outcomes? And in that regard, there are two options, right? Is it an aggregate choice, right? You've done the incredibly complex maths, they're looking at your different industries, looking at your different outcomes, and then you've come up with a reward strategy that seems to embody your optimal position. Now that can't be right? That's inconceivable. But it does seem conceivable that what you could have from the common owner is industry selection. So you could select a low-powered incentive in some industries and a high-powered incentive in others. Now, is that plausible? Well, I think from a cost perspective, in comparison to the cost of monitoring individual firms, I don't think that would be prohibitive. It would, though, create a paper trail that would generate huge enforcement and reputational risk. So it seems to me improbable, but it's conceivable. But then the key question, I think, for your paper is whether you see it happening. And at least in my reading of the paper, and I may have missed it, I didn't see any indication of industry level variation. Now, maybe there's something hiding in the fact that your Hoburg Phillips industry classifications came out with different results than your other classifications. I don't know. And certainly your differences analysis is just fascinating, suggesting some form of conscious driver, but nothing actually on industry variation. And the other data that we have, for example, Koch et al. From 2020, suggests no industry variation. So if we don't see variation, in that case, it means that in some industries, in some of the time, shareholder passivity enables lower powered incentives that result in anti-competitive behavior. But it's got nothing to do with common owner reward choices or common owner preferences. Well, then what is it? Because your findings are really fascinating, and I don't know, right? But it could just be, the unsurprising consequence of shareholder passivity. It could have something to do with the identity of particular funds that enter companies and the reputational and political constraints to which they are subject. But I don't know. Now, very quickly, I know I've taken up too much time, but just one more minute. Think about this then from the other side of the coin. If common owners have preferences for low-powered incentives that drive the lazy enhancement, the lazy alignment strategy, well, they've got to be sure that their managers will follow through on this, right? Because there's no point in committing to it if your managers aren't going to follow through it and actually will end up competing hard with your competitor firms and destroying your common owner value. So the question is, can you trust them to do your bidding? And when we think about managerial tenure and reputational capital, I think the answer has got to be split again along an industry landscape. If you have a company that looks like this, with significant protections from entry, then sure, I think you could trust them to do your bidding. But if your industry looks like this could happen, then no way will they do your bidding. It seems inconceivable, because they know that they don't want to end up like the first two of these guys. And if anyone listening to this talk doesn't know who the first two guys are, well, that's precisely my point, right? Because we don't know who they are, right? They are the CEO of of research in motion and of Nokia in the noughties. As final point, and then I'm done, right? So we don't think we can trust the managers to do this either. But then finally, when we look at the incentive packages, does it seem likely that the variation we see in those incentive packages would drive these different types of outcomes? Now, Florian says that they are significant and amount in real terms money to about 10 million. But when we look at these packages, I'm not sure, right? So here's a package of a Delta Airlines CEO in 2019. And as you can see, and I won't take you through it, but it's very significant. Now, Florian and his co-authors find a 6% variation, but it doesn't seem to me on something that looks like that 6% up or down would be something that you could rely on for making any difference at all. So my conclusion is this is a truly fabulous paper, and I encourage everyone to read it. But I still think that we're searching for a transmission mechanism.
Thanks very much, David. You fully met my expectations of challenging the conclusions of the paper. I suspect we will hear a bit more about the link between incentive strategies and market structure, because I already have a competition lawyer on the list. But before we open it up, Vicente, the floor is yours. I think you're still muted, Vicente.
Okay, so now you should be seeing everything.
Yeah,
okay.
Yeah, great. Good. Thank you.
So many thanks for giving me the opportunity to discuss this paper, this 90-page paper in 9 minutes. It's been quite a pleasure. It's a very rich paper. Let me start by summarizing the paper, actually. Sorry, small technical problem here. Okay, so this said, I'm going to start with the model. So in the model, managers exert cost-cutting efforts. They are set to an incentive contract that is linear on profits. Prices are set optimally, but very importantly, they're independent of the effort problem. So this is like an automaton. Prices are set by someone else that is not the owner, so to speak. And incentives are set by a majority owner that may have ownership in rival firms. This is the common ownership component of the paper. The main results of the paper, and I think the innovation of the paper, is that as common ownership increases, first of all, incentives become flatter, right? And also firms become less efficient, okay, as a result, okay? And in equilibrium, firm profits are going to increase with the degree of common ownership because of this inefficiency. And the intuition is very clear. It's like in the margin, my own inefficiency improves the results of commonly owned firms. So by me being less aggressive, there's an externality that normally I wouldn't internalize because these are other firms, but because we are commonly owned, it's going to create this kind of externality that is internalized by the common owners. Okay? So this is the main result of the paper. The kind of the slack, the competitive slack that the low power incentives create is kind of captured by the other firms. Okay, and I think this was very clear in the presentation. My first comment is that I think there's still something to be clarified about the objective of the paper. The paper is very rich, and I found it very, very interesting and very clearly written. But at times I felt it wasn't clear what was the actual objective of the paper, okay? So the setting I find is quite restrictive, it's quite specific, okay? And I would like to know more about what the role of the setting is. So first of all, managers have linear incentives on profits. There's no concavities, no convexities, you know, it's a pure linear contract. Importantly, you cannot give relative performance evaluation. So if you could really control the pay, the optimal contract that comes out of this situation is a contract that loads positively on your own profits, but also loads positively on other people's profits, or at least a contract that, you know, doesn't induce you to outperform your rivals. You know, that's there's an old paper by Agarwal and Samwick that follows that kind of reasoning, and this is something that is shut down in the model by assumption. This is something that is not allowed. So the managers do control the pay, they do control the contract, but they have a limited menu. It's just a linear contract. Okay. The managers, as I said, cannot affect the pricing policy. And this is important because the only way in which you can increase the prices of your firm in the model is by becoming less efficient. Right, it's the only way, because prices are set somehow by some automaton that we don't control. The only way that I can please my owner in a way, not directly but maybe indirectly, is by becoming more inefficient. Right, and the final thing that I was aware of is that the percentage of ownership of the common owner doesn't change according to what I do. So there's an incentive part that I could use, which is I could increase or decrease my think of a continuous kind of exit mechanism, so to speak. That mechanism is also not relevant to the paper. It's not something that you guys are changing. You're keeping it constant. And I think, these are all fine. This is part of a modeling strategy, but I would like to know, whether these are here for tractability. For example, linear incentive contracts would be simply something that's there for tractability. Maybe for realism, you don't want the managers to kind of have control over the pricing because you don't think that's a realistic assumption. Or maybe trying to make a point. I think the paper maybe tries to make a point of saying, even if managers or if owners, don't have control over the pricing policy of the firm, there is still a mechanism that will work, right? But in a way, I thought that was a bit of maybe it's a reactive comment to some of the comments out there in the space, in the literature. But I thought, it was something that it was worth clarifying. And I'm not really sure about, this pricing assumption in the sense that if you allow the pricing to be free, I suspect that the mechanism of the paper will largely disappear. Right? The moment you allow the prices to be set freely, you actually want to be efficient because you can achieve the same kind of objective by setting the right prices. So in a way, we end up with a strange conundrum, which is like, if the owners have control of the prices will go up and the firms will be more efficient. If the owners don't have control over the prices will go up and the firms will be less efficient. So no matter how you cut it, we're going to get anti-competitive results, but through very different mechanisms. So it's almost like an either-or type of situation, which I think is an interesting point. But at the same time, it made me think about how the paper was organized. Couple of comments in the paper. So in the model, this is basically what I was saying before. So, the model common ownership has anti-competitive effects in the sense of higher prices, but this is ruled out, almost by assumption. The prices are hardwired to be not part of the optimizing part of the manager, right? If both effects were present, I don't think that this effect would be there. I think we will end up in a world similar to Schmidt or Wraith, in which markups and market stealing would interact, and I'm not sure this would be the case. I think the other part that I thought was very interesting of the paper is this idea that owners can be passive in order to provide these flat incentives, and for here I think it's very important to think that the status quo is a status quo of low incentives. Right, and I think, this is very intuitive. We have a long literature on agency problems saying, managers have low incentives. We want to incentivize them by giving them a higher cut on the profits, et cetera, et cetera. But I'm not so sure. I think CEO implicit incentives can be very powerful. Right, the threat of being fired, the threat of not doing your job properly, the competitive nature of the job. It's not obvious to me that by doing absolutely nothing, we're going to be above or below this optimal level of incentives. And I think this is something that, it could be very plausible, but it's to me, it's not totally guaranteed. The empirical analysis, I think it was very clearly explained. So link measures of wealth performance sensitivity to common ownership. In the first part is through more like a panel regression. In the second part is using the inclusion of rival firms in the S&P. And the results are very clear that the wealth performance sensitivity goes down for firms that are more commonly owned in the cross-section, so to speak, or in the panel section, but also drops when rivals enter the S&P 500. And a couple of comments here. You're assuming linearity here. In reality, when contracts have convexities and concavities, you can change wealth performance sensitivity by just having more or less profits. By moving somewhere along, the function of higher or lower profits. So you could conjecture two firms that have exactly the same incentive program, but because one is more profitable than the other, the wealth performance sensitivity changes. And this is something that I'm not sure is dealt with or needs to be dealt with. Second point that I think is important, management contracts have a lot of inertia, and in particular downwards inertia. It's relatively easy to give more options and more stock options and more shares to create higher, steeper incentives relatively quick, but to depower incentives is probably a costly, slow process. So I wonder if you could do something with, more versus less common ownership, because I suspect that the effect is quite sluggish on the way down and is quite sharp on the way up. This is something that if it works, it would link the causal effect much more tightly, okay? Because it shouldn't be symmetric. When you have more common ownership, it should take a while to depower those incentives. When you have less common ownership, it should be relatively sharp, okay? Was thinking that some of the pre-existing empirical evidence focuses a lot on pricing and markups. I wasn't sure how it squares with all the previous empirical evidence, this empirical evidence and the model. One thing I was thinking of is, could we revisit Agarwal and Sandwick now that we have much better empirical methods, better measures of common ownership, better measures of relative performance evaluation? This is an old paper with very coarse kind of estimates, so maybe we could kind of do a better job now that we have a much more literature that helps us to do the exercise. I think a couple of more comments. I think you could focus directly on efficiency. It's a tall order because efficiency is not easy to measure, but this is really one of the outcomes of the model. So you could see if there's a sense of markups or efficiency changing. And I think you should emphasize definitely two innovations of the model, which is that common ownership can drive inefficiency, but also that by being passive, you can reach the actual level of flatness that is necessary. Summing up, I really like the paper. It's a very comprehensive model of management incentives and the common ownership. The setup is restricted, but because it's trying to make a point. And I think that should be clear in the model, or should be clear in the paper in terms of what is necessary, what is not, and what are you trying to achieve with those assumptions. So it is the minimal set of assumptions that delivers the channel or not. But in general, very nice paper, very well written, and definitely lots of food for thought. Yes.
Thanks very much, Vicente. Florian, would you like to take a minute to respond to the comments of both discussants?
Yeah, that'd be great. Thank you so much for these two excellent discussions, really wonderfully complementary. Let me start with David's points. The first one on entry barriers to entry and essentially issues of contestability. I completely agree. What the model does for tractability reasons is just we shut down the entry channel completely. And so I agree with you that we would see heterogeneous effects across industries depending on whether entry is or is not possible. We would expect the entry effect to attenuate the common ownership effect. I am not aware of, we're already in somewhat tricky territory here in terms of being at the intersection of executive compensation and industrial organization. I'm not sure we can, and so we have that prediction now in terms of entry, if we allow that. We would have another one when it comes to product differentiation, which would give you something similar, which is the more product differentiation within an industry, the weaker are going to be these common ownership effects. We're not doing anything on that industry variation side. One could do this empirically, but I think that it's my understanding of this is probably not super strategically chosen by the common owners. So I'm with you on the assessment that this is probably not happening on an industry by industry level. But I do disagree with this then saying, well, this is then just an issue of passivity. I do think that the common owners are essentially seeing this across a range of different industries. And then in terms of this passive mechanism, they're probably just choosing to be relatively passive. However, I would stress that there's a second set of mechanisms which are completely shut down in our model, namely these active ones. And so I can point you to in the direction of Nathan Chiquita's paper, who documents 30 even publicly available interventions which I think these common owners are going to engage on depending on which industry they're in. So I think you could probably view our model as sort of a baseline effect for common ownership influencing anti-competitive product market outcomes, and then the industry variation for common ownership to influence probably come through other mechanisms. Now, that's not part of our paper, and that's just my conjecture, but that would be, let's say, my first reaction to this. Is 6% enough? I'm with you that 6% doesn't seem like the biggest thing. I want to put it in perspective. The 6% or the 6.6% is as big as firm volatility, the effect in terms of magnitude. Okay, and let's remember what firm volatility is. If you do a standard Holmstrom-Milgram linear incentives type model, the first comparative static that you do is you play around with the sigma squared. Okay, so our effect is as big as like the biggest postulated effect on managerial incentives from like the canonical incentive theory. Now, of course, you could say, well, there's another effect where Edmonds, Gabex, and Londier, they say size is as important. So it's true that our common ownership effect isn't as big as size, but I'd say it's the second biggest determinant in terms of magnitude for managerial incentives. Okay? So I'd say that it doesn't seem like much, but if you put it in the context of what is out there in terms of empirical estimates, it's pretty large. Okay, now to Vicente's comments. I completely agree that he's exactly right in pointing out that we study a restrictive setting that we justify through three different things. So saying like we want to have a set of minimum conditions. We're handicapping ourselves explicitly in order to ensure that we're not assuming anything implausible and that this can go through minimum assumptions. On the other hand, we also invoke stuff on realism because we're saying, look, we're not allowing for certain types of things that the manager can do. We're not allowing the manager, for example, to selectively intervene across different markets, or we're not allowing any communication between the investor and the manager. Okay? And we also is justifying some things in terms of tractability, which is we use linear incentives again because we have essentially what I call it a turducken model of common ownership, because we have common ownership on top of a managerial incentive problem, on top of a productivity improvement model, on top of a product market competition model. Okay? And so that requires us to make a certain number of assumptions on the tractability. I'd say one additional thing on the linear incentives is that we also want to stay as close as possible to Edmonds, Gabex, and Londier, who also assume just a linear incentive slope so that we can have a nice match over with wealth performance sensitivities. Okay? So I'd say that's the one that I'd say it's like there also not just for tractability reasons, but also so that we can get a nice link between theory and incentives. Now, one additional thing, which is great, I think that Vicente highlighted here, is that in our model, everything works through productive inefficiency, okay? And the markups are unaffected, essentially. Okay, common ownership, all it does is like raises the costs, okay? And then you get cost pass-through, and so the markups may change a little bit, okay? Because we know that cost pass-through isn't necessarily 100%, okay? But the markups are unaffected. I agree that if we also had the direct pricing thing, you would get a markup effect in addition to, or substituting essentially for that cost inefficiency effect. Okay? Why are we stressing so much, I'd say, the productive inefficiency one, the stuff on the cost? We're mainly doing that because that's what the empirical evidence says. So the empirical evidence that we have out there, it says that really that doesn't seem to be much happening on the markup side. So for example, the ready-to-eat breakfast cereal by Bacchus, Conlon, Singleton that I discussed on Friday says no effect on the markups. They can't say anything about the cost. Okay? The Aslan paper that looks at consumer goods finds, yes, common ownership is associated with higher costs, but doesn't find anything in the markups. The Koch et al. Paper also says, well, there doesn't seem to be anything happening in the markups. So I'd say the reason why we do this is we also want to have a unifying theme here that matches the empirical evidence. I'm totally sympathetic to the idea that you could have more direct interventions, and then these direct interventions would directly then show up in the markups. But for one, we're just going with this very indirect passive one, and that one gets you stuff that is broadly consistent with the evidence. Okay, I'm gonna leave it here and look very much forward for a question, but thank you again for these fabulous discussants that really give us a lot of food for thought.
Thanks very much. I should mention we are stopping the recording now, so those